Hello, investor friends! Today we have some more valuable insights from Charlie Munger at the 2022 Daily Journal Corporation annual meeting. During the meeting, Charlie humbly expressed that he and Warren Buffett, despite not intending to be global gurus, have unintentionally become influential figures in the investment world. Charlie Munger's wisdom offers us many historical lessons and insights that can help us avoid repeating past mistakes. These insights pertain to various critical areas, including inflation, the effects of money printing, the implications of rising interest rates, and more. If you enjoy learning from some of the best investors of all time, don't forget to like and subscribe to our channel. Your support greatly helps with the YouTube algorithm, and we genuinely appreciate it. Let's get into Charlie Munger's insights and gain valuable knowledge from one of the most successful investors in history. Charlie Munger, the legendary, much older and wiser 99-year-old investor and vice chairman of Berkshire Hathaway, who is also known for being Warren Buffett's longtime business partner, has offered several insights on the current economic situation, inflation, currencies, and geopolitical risks. He believes the stock market has turned into a speculative casino of gambling and detached from underlying stock values in many cases. This is what creates bubbles that eventually pop. When a shareholder asked about Charlie Munger's views on the current inflation and its comparison to the 1970s when Paul Volcker was the Fed chair, Charlie Munger said, Charlie's thoughts on current inflation compared to the 1970s stagflation. Munger explains that this current inflation is not the same as what Volcker fought, and that politicians do not seem to have the same will to allow economic hardship to battle inflation. Volcker was allowed to do whatever it took to get inflation under control. Powell may not be given the same freedom. Charlie's recession warning due to inflation. Charlie Munger's thoughts about current inflation compared to the 1970s stagflation can provide some important lessons for investors. Look back at history. It's important for investors to consider historical economic challenges like the 1970s stagflation to better understand how current conditions might affect their investments. Unusual responses. Charlie suggests that the extreme actions taken by policymakers during the 1970s were unique. In today's political climate, it may be harder to implement similar measures to address economic issues, and this can impact financial markets. Embrace uncertainty. Recognize that predicting the future is uncertain. Diversify your investments and be prepared for different economic outcomes. Adapt to unique problems. Current economic challenges may be different from those in the past, so be flexible with your investment strategies. Prepare for worse scenarios. Be ready for the possibility of more severe economic problems, as Charlie warns that today's troubles could be even more challenging to fix. Beware of excessive money printing. Be cautious about the long-term consequences of unconventional monetary policies, as excessive money printing can have risks for asset prices and currency value. Diversify and manage risk. Given the uncertainty, diversify your investments and manage risks effectively. Having a well-diversified portfolio with different types of assets can help you navigate various economic situations. Charlie Munger's opinion on whether major interest rate increases, similar to what occurred from 1950 to 1980, are likely to happen in the upcoming decades. Out-of-control money printing does eventually lead to financial consequences based on history. He says Japan not suffering from their own money printing may be the exception, not the rule going into the future. Trouble is near. What needs to be learned? Charlie Munger's perspective on the possibility of a major increase in interest rates in the upcoming decades, especially in the context of extensive money printing, offers several important lessons. There are some important lessons to be learned about the uncertainty and potential risks of extensive money printing by modern nations like Japan, the US, and Europe. While Japan's experience has shown that such actions can be carried out without immediate severe inflation, it's crucial to remember that these are uncharted waters. Munger suggests that Japan's ability to cope may be influenced by its homogeneous culture and demographics, while the US, with its diverse society, faces greater challenges. He warns that printing too much money can eventually lead to severe economic problems, and the US in particular must navigate its unique complexities. Munger's message underscores the need for caution and prudence in monetary policies, as well as the importance of considering a wide range of factors, including cultural and demographic influences, when addressing economic challenges in today's uncertain economic landscape. Charlie on questions about what to do with all of our serious problems of national debt and a demographic storm driving deficits higher. The next question, as articulated by Becky Quick, essentially asks if Charlie Munger believes that the United States will handle its money printing issues as successfully as Japan did, and this is what he had to say. No consequences for government spending and debt just leads to more of the same for political gain. The US is very different than Japan, and the outcome of our endless national debt and dollar printing should be very different. The US has been the economic growth engine of the world in the last 100 years, and the consequences could be global. Huge political risks are present when currency buying power, earnings power, and savings value are destroyed by a government. A Western country can be at risk of a strong man coming to power that promises to solve all the economic problems and is rewarded with allegiance when trying to do it. His predictions go beyond just a stock market crash and explain the dangers of an economic crash and the risk of political instability. Charlie answering what happens after quantitative easing ends. It appears that Charlie Munger initially responds to a question about who will lend to world government after quantitative easing ends and the Fed allows bonds to mature off its balance sheet. He mentions his thoughts about Chinese real estate and also provides a somewhat grim solution regarding the United States. Currency going to zero. Munger predicts that the US dollar will likely go to zero value over the next century. This is not as crazy as it sounds. The US dollar has lost over 96% of its value since the Federal Reserve was founded. The US dollar has also lost 86% of its value just since 1971, when the US left the gold standard. His predictions are almost certain based on past trends of purchasing power erosion. This should serve as a wake-up call regarding the long-term threat of inflation to savings accounts not invested in assets. Many of his warnings revolve around inflation and the political instability it can trigger. There is much to think about.